Hello, welcome to the 13th episode of The Financial Incline. I'm your host, John Bovard. Today, I'm thrilled to be joined by Billy Wersel. Billy is a vice president at First Financial Bank, where he works as a commercial banking team lead. He's responsible for managing a team of commercial lenders in the greater Cincinnati region. In addition to managing a team, he's also responsible for managing his existing client relationships and bringing on new client relationships to the bank. First Financial specializes in providing mutually beneficial, interactive banking relationships for clients seeking a consultative, hands-on approach to banking. During our discussion today, Billy and I dive into financing a deal. We talk about things such as how to use bank financing to scale and grow your business, and also what you can do and how you can work with the bank when acquiring a new business. We talk about things such as how the bank values a business and how much that will approve you for if you're looking to purchase a new business. So for those of you wondering what the banking side of things looks like when you're buying or selling a business, make sure you check out this episode. So without further ado, here's my conversation with Billy Wersel. Hey, Billy, thanks for joining me today.
Hey, John, how you doing? Thanks for having me.
Yeah. So one of the things I mentioned in my intro. So myself and a couple of business partners went in. We were able to acquire a local company, and you helped us throughout that process. So you provided great insight to us for what the bank was looking for, some business valuation strategies that you used, what we could be approved for potentially, and really gave us great insight. So that's why I wanted to have you on today, so that you could share some of that and help provide those listening and those watching with some great information around the banking and financing world.
Awesome. And again, congratulations on that acquisition. That was a lot of fun helping you along the way. That's a great deal for you.
Yeah. Thank you. So to dive in here, so how did you get started in commercial banking?
So I have a pretty untraditional pathway to banking. I grew up in a small business family, so I thought I'd be an entrepreneur. My grandpa in 1952 with his best friend Stan Handorf, they were both knuckleheads, and they knew that college wasn't the pathway they were going to take. And they did the next best thing and started a business, and that business was a lawn care and mowing business. By 1963, they decided that they wanted to buy a plot of land up in Mason, Ohio. And anyone who's familiar with Mason, Ohio, back in the day, that was nothing but farmland. So everyone thought they were crazy. And they bought the land with the vision that they were going to start to grow their own trees and shrubs and turn it into a landscaping business. And a year after they bought that land, some developers approached them and said that they were going to build a 364-acre amusement park to be called Kings Island. And they actually they bought some of their land to build that exit off of 71. And as soon as that was built, metropolitan sprawl just continued to climb north, and business is still there today. My dad, that's what he did growing up, and I thought I'd drive a truck and chew tobacco and sell shrubs all day. And my senior year of high school was 2008, 2009. Anyone who knows those 2 years knows it was the Great Recession, and it was a really tough time for my dad and his business. And he sat me down and said, "Son, don't do what I do, but help people like me." And it sounds kind of corny, but that was kind of my light bulb moment where I wanted to be in a career where I was around entrepreneurs and helping them. And he actually had a banker at the time that they'd been with him for decades, and he brought him up, and to me it made total sense. So from there, I went to school at Bellarmine University in Louisville, Kentucky, and majored in finance, minored in accounting, knowing what I wanted to get into banking, and was looking at jobs in Louisville and in Cincinnati. And Cincinnati just has a more robust economy, and there's a lot more banking opportunities. So I left school and moved back home to Cincinnati and spent 4 really good years at a larger bank in town, and spent most of those 4 years in credit, really building the foundation to understand why banks operate the way they do, why they make the decisions they do. And after 4 years, I started to realize that bigger isn't always better in banking, especially because I really want to serve the lower middle market type companies. And
Right.
I ended up getting an opportunity in March of 2017 to join a small regional bank, Main Source Bank. They're 3.5 billion in assets and based out of Greensburg, Indiana. And within a few months of joining there, my boss pulled me in his office and said, "Well, we're being bought." And for me, that was kind of a oh crap moment because I had an opportunity to be a lender. And anytime you hear the word acquisition in banking, you get a little nervous, but
Right.
it's worked out to be a great thing. And First Financial acquired Main Source Bank in 2018, and I've been here ever since as a commercial lender.
Yeah, that's fantastic, and I love that story. That's great. My parents' career also shaped me into being an entrepreneur, and that's great that you had that experience. Obviously, 2008 was quite the tumultuous time for all businesses, but it's amazing how that kind of shaped your career going forward. So.
Yeah, absolutely.
Fantastic. So what type of services do you provide business owners and entrepreneurs?
Yeah, so I'm a commercial banker, and every banker you talk to, commercial banking means something different. So for us, we call on companies that are 3 to 500 million, and I have 22 clients. My average client revenue is roughly 21 million, with average commitment of 4 million. Just being in Cincinnati, I work with a lot of manufacturers, distributors, construction type businesses, and some professional service firms. Typical clients, they have deposits with us as well as TM services. And pretty much all my clients have a revolving line of credit to help fund working capital. And then just different forms of term financing to fund real estate, equipment, acquisitions, and buyouts.
Okay.
So get to see how the sausage is made and meet a lot of really interesting people. So banking's it's a really fun career.
Yeah, it sounds like it. You definitely hit a broad gamut of people. So, if you could describe to me, so let's say there's somebody out there and they see a business, maybe it's a family business, maybe their uncle's in it, or they know somebody that's nearing retirement age and they're thinking about selling their business. So if we were just to focus on that aspect, what would be, somebody out there, they probably don't have a lot of money. They can't buy the business outright in cash. And let's say it's, anywhere from a $3 to $5 million revenue type of business. What type of options does that person have when they're looking to finance that purchase of a business?
There's a lot of options. I mean, you mentioned cash. Most people don't have the cash to buy a business up front. So, I mean, I've seen some cases where, proven operators come in and find a business owner that maybe they want to retire in the next 5 years or so, and they can work out some type of sweat equity deal where they come in and have performance metrics, and if they hit those metrics, they get a percentage of equity, and then eventually they get presented the opportunity to buy the business. And a lot of times for younger entrepreneurs, SBA financing is always an option because usually it requires less money up front and a longer amortization to pay off the loan. And then really your third option is just traditional financing from a bank. And usually what a bank will do if you're looking to acquire a business is, they'll look at cash flow. Is the cash flow available to service debt sufficient? And then they'll amortize that out for a shorter period of time. But yeah, those are your primary options. And sometimes traditional financing doesn't finance all of the deal. So something that I see on a lot of the acquisitions we do is forms of seller financing, which usually what I see out in the market is about 1 times EBITDA. And then usually a traditional bank for a full recourse type deal where you have guarantors will fund up to like 2.5, 3 times. And if it's a non-recourse deal where you don't have guarantees, usually 1.5 to 2 times EBITDA.
Mm-hmm. Yeah. So that's that kind of brings up our next point here. Something that I was curious about, like if you're looking at it from the bank's lens, and that person's looking to get approved, what sort of factors go into it? And I know you mentioned EBITDA and non-recourse debt, things like that. So if you wouldn't mind, just for people listening that may not be as familiar with it, kind of describe what EBITDA is, and then how that kind of ties into the bank's approval process, and how they sort of determine, okay, we're willing to give you up to this amount, for a loan. How do they go about kind of approving those different loans that they get?
Yeah, no, that's a great question. So banks, we are cash flow lenders first. I think everyone's heard the term cash is king.
Yep.
That's very much true in banking. And it's usually the first thing that we look at. And we always want to ensure that the cash flow available to service debt is sufficient to cover the proposed annual debt service. And the way we do that is we calculate EBITDA, which means earnings before interest, taxes, depreciation, and amortization. And then we usually subtract what the expected distributions would be. And then if there's any capital expenditures, we'll deduct that as well. And that gets you your cash flow available to service debt. So that's your numerator. And then you divide that number by what your proposed annual debt service would be. So that would be, let's say you do an SBA loan, $1 million loan, it amortizes over 10 years. Your annual debt service would be $100,000 plus whatever your interest payment would be. And usually banks want to see that the company has sufficient cash flow to service that debt by a margin of, we'll call it 10 to 15 points. And I'm sure some of you who are listening to this have heard of the, debt service coverage ratio or fixed charge coverage ratio. That's kind of the holy grail of bank covenants. So that's usually the first thing we do. And then banks, our secondary source of repayment is always collateral. So that's usually the second thing we'll look at. And if you think collateral for companies, it's most commonly accounts receivable, inventory, real estate, if you're buying any real estate, and then equipment. And then some other forms would be investment accounts, cash surrender value of life insurance or land. Mm-hmm. And then the third source of repayment is personal guarantees. A lot of times entrepreneurs, they'll want to buy a business and they won't want to guarantee the debt. But if the cash flow, isn't sufficient in any of the, past 3 years, or the day one balance sheet or cash flow leverage won't be great, then usually that's when a bank asks for personal guarantees. And then lastly, banks just tie it all together, and we create a risk rating model. And that risk rating model also kind of directs, what kind of pricing you get on the deal.
Yep. Well, great. So it definitely sounds like there's a lot that goes into it. And and collateral, for those of you that might not know what that means, that's whatever the bank can get their hands on, right? So if that business goes under, if you're not making your payments, what can they come and collect that's valuable that they could potentially sell off? So I appreciate you kind of walking through what those are, and even that exact formula that you described when you first started talking, can be very, very valuable for people that are maybe looking to borrow or purchase a business, or even investment real estate as well. So that's great. So kind of looking at the current environment, obviously what's top of mind for everyone now is inflation being as high as it is, and the Federal Reserve raising interest rates. We're definitely in a rising rate environment now. So just if you look back across this year, what sort of challenges are your clients facing?
Yeah, no, that's a great question. And a lot of the challenges are actually what you're hearing on the news. I tend to kind of blank out a lot of the news you hear because it's doom and gloom for the most part. But I will say that the primary challenges our clients are facing right now is just, the first one I would say is labor. The labor market has been really challenging over the past few years. It seems like the employees have more of the leverage, and just for businesses that, have an hourly workforce, it's extremely competitive. It seems like people aren't as loyal. A lot of times people will, to hire 5 people, they'll have to bring 20 people in and half of them will show up. And a lot of times once they hire that person, sometimes they don't even show up to the job. So we see things like that. In the professional service world, you have now with this work from home environment, you have businesses on the East and West Coast or even Chicago that the demand for higher wages is higher there and it's super competitive. So they're poaching remote workforce from the smaller Midwestern cities where they know that they can outprice their existing employer. So we're seeing that, which is interesting. Supply chain, no surprise, supply chain has been a serious challenge for folks. I've noticed a lot of times lead times for companies are continuing to increase, and overall demand for goods and services is high, but just getting products through the door has been a substantial challenge. And then it's kind of interconnected with supply chain, but just the inflationary pressures. A lot of our clients, their direct cost for their goods is going up, so they have to pass on price increases. But when you work with, when you have clients that are, some larger clients, it takes longer for you to pass on the supply chain or the price increases. So what you get is just margin compression. Another one I'd say for capital intensive businesses, just cyclicality. That's a trend I see with printers or manufacturers that have to buy a lot of equipment. Because a lot of times if you want to grow top line sales, you have to invest in equipment to ensure you have the capacity to do so. And sometimes it's just a timing issue. And then lastly, I would just say in the lower middle market space, business owners, they wear a lot of hats. They feel a tremendous amount of pressure, and their business is their financial kingdom, but they're also responsible for putting food on the table for a lot of families. And I saw that firsthand with my dad when he was going through a tough time. And during the last recession, I mean, he wasn't collecting a paycheck because he had to be able to, fund payroll for the people working for him. Mm-hmm. And it's just a lot. Business owners, I think a lot of people, when they think business owner, they think country club, Range Rover, going on nice vacations, but it's you're in the trenches. So I would say those are the primary challenges I see.
Yeah. That's I think you hit the nail on the head there with what I've seen. It's a very odd time because you've got unemployment very low, wages are remaining high, but yet inflation is where it is, and the cost of goods and the supply chain issues are making it very difficult, on companies. So if from a banking standpoint, how have you kind of helped your clients to navigate some of these challenges?
Yeah, no, that's a good question. As a banker, it's hard to just point a wand and solve these problems for clients, but really what all bankers are called to do and what we can do is we can provide a very hands-on consultative approach with clients and educate them on the way banks make decisions. And really, I think it's important to acknowledge, if you're a banker, you're the face of the client to the bank, and you're also the face of the bank to the client. And the best way to make that work is have a mutually beneficial relationship where you're very proactive and consistent with your outreach. And, one thing that I do, and one thing that us bankers at First Financial are called to do, is have quarterly meetings with our clients. We just call them quarterly client reviews, where we sit down and we actually put together a one-page document that summarizes all the key credit metrics banks use when we make decisions. And it's very helpful because businesses don't grow like this, right? They grow like this. So when you're consistently meeting with your client, you really understand their business, you understand their down cycles, and you're able to proactively manage that with your credit partners. And what it does is it creates credibility for your client to the bank. And as well as a banker, it creates credibility with your credit partners, and it allows you to digest those down cycles better than just, meeting with your client once a year. And when times are good, it's great, you do your renewal. But when they're bad and then you're trying to do a renewal, next thing you know, your credit partners are saying, we can't do this, we can't do that. So I think that's a very important part, and that's something I take pride in. I'm a credit nerd by trade. I never wanted to grow up selling widgets anywhere. I kind of fell into this industry. So yeah, I'd say that's the biggest thing we as bankers can do. And then, in recent months, what we're seeing with the supply chain challenges is we're seeing companies invest in equipment to cut out layers of their supply chain. So a lot of what I've been doing this year is helping companies streamline their operations, sharing what some of the best clients and operators I work with are doing, but also helping them finance equipment.
Great. Yeah. So, and we talked about sort of the macro factors that are creating a lot of challenges this year. What have you seen from an overall, kind of so far this year, kind of an activity level, right? So as far as people expanding their businesses, opening lines of credit, purchasing businesses, buying more real estate, has the activity level still remained high for this year?
I would say where I've seen the biggest slowdown would be real estate expansion, for two factors. I think inflation is very real. Certainly earlier on in the year and towards the latter half of last year, we saw the price of steel and lumber and labor drastically go up. So just the cost to build, 100,000 square foot building this year versus the past 2 or 3 years has been drastically higher. And then you have a rising interest rate environment as well, which, right, people, when they make investments, they're, trying to get the best return on investment. When interest rates increase, that kind of inhibits that a little bit more. Overall demand for goods and service has remained high. I mean, that's one thing that, and it seems like doom and gloom, but overall demand is there. The supply chain inflationary pressure and higher wages is causing margin compression. And then another trend I'm seeing is just, I call it COVID cash. Companies over the past 2 years have had a lot of cash. There's been government programs that benefited from. We're now starting to see companies work through that cash, either in the form of this, so buying equipment, things like that, or buying inventory. So some industries are unallocated, so people have strong demand and get their sales up. So I'm seeing it. I did the math on my portfolio at 12/31. Our overall client utilization rates on the line was about 20%. Now it's pushing, 40-50%, which is interesting.
Wow, that is. Yeah. Well, great. So if there were, if there's somebody out there that's interested in buying a business, what are 3 things that they can do to start to prepare for that, from a financing perspective? Is it contact a couple different banks? Is it try to, pay off any debt that they may have? Is it to build up their balance sheet? What are a couple of things that someone should look to do if they know that, hey, a large purchase or a big acquisition might be in their future?
Yeah, no, that's a great question. Just thinking about the clients I've worked with in the past, I've found the most successful serial acquirers of businesses, they tend to have a great team around them. So this team includes professional service providers. So think banker, attorney, CPA, insurance, investment banker, wealth advisors. They have a good team of people that they trust to help them, analyze opportunities and plan for the future. Mm-hmm. Wow, sorry.
Oh, good.
I just got like a bug in my throat. And then industry experts. It's very useful to bring in industry experts to help you understand and operate the business. A lot of the most successful acquisitions I've seen are when an investor brings in a successful and proven operator to come in and run their business. And a lot of times they'll give them a, 10-15% equity stake, so they have skin in the game. And then from an investor standpoint, then you're not as involved in the day-to-day. And then lastly, if you're going to acquire a business, don't be a bully. If kids don't like bullies, what makes you think adults will? And, I've seen people that have the approach of being a bully, and a lot of times that ruins deals. And some of the most successful acquirers, they know what their big sticking points are, and they work to make a fair deal. So I would say, that's some of my advice. I don't know if I fully answered your question. I kind of went on a tangent, but
no, that was good. That was helpful. Of what to consider. And you're exactly right. Having your team involved, talking with people that have done it before, I think is crucial, because there's so many different steps, and that's one of the things I learned too. There's so many different steps that go into the process.
Yeah. And on that topic, I'm sorry to cut you off, but on that topic, if you are looking to acquire a business, I think one thing that sometimes is overlooked is just, first and foremost, you need to figure out if there's a fit from a culture and people perspective, because at the end of the day, businesses are they're people businesses, right? And success starts with having the right people and culture, and without it, businesses die. So you really need to know who the key players are to help the business succeed in the future, and you need to get their buy-in, because the most successful deals usually let these people become stakeholders. And if culturally there's not fit, that's a key component to kill a deal. And then lastly, when you're looking to acquire a business, you really need to understand both historical and projected cash flow. So when I think of those things, you need to understand who their clients are. Are there any heavy concentrations with the client? What does the business look like if you lose your top 3 clients? Are there any synergies or low-hanging fruit or cost cuts you can make? And another key component too, if you're looking to buy a smaller business, who owns the client relationships? Because if it is the seller, you want the seller to stay on for a bit, because that seller leaves, you're at serious risk of flight risk for the existing clients. And if the cash flow is volatile too, you really need to dig in to get comfortable with a good baseline EBITDA number is going forward. So, I would say those are really the primary things to look at if you're going to acquire a business.
Mm-hmm. Yeah, that was great. Customer concentration, and you're exactly right. Who's running the relationships? Who's going to run that? Who can replace them? That's definitely there's so many different factors that go into it, and we could talk for another 15 minutes just on that one, but that was a great explanation.
Yes, definitely.
That out for us.
Definitely.
Yep. But yeah, you kind of touched on, how a business is typically valued. So, as we wrap up here, is there anything else that you would share for, somebody that's interested in different financing options, or maybe they're looking to get approved or looking to make a major purchase in the future? Any other last pieces of advice?
Well, one, you can call me. And as you experience, I'm a deal junkie. I love working through deals, and I own the initial underwriting process, so can quickly go through that deal point summary that I mentioned. But if you are a business owner, you should view your bank as a mutually beneficial strategic partner, because we are a provider of cheap and lazy capital. So if you think of your layers of capital, cash and accounts receivable is your cheapest form, but the bank is the next cheapest. And if you think of the other layers behind a bank, you're talking mezzanine debt and private investments, and usually they're going to want a double-digit return, whereas banks are historically single-digit type interest rates. And we just went through the lowest interest rate environment we've had. And now, obviously interest rates are going up, but when you compare us to what it takes to bring on an outside investor, we're still substantially lower. So with that said, be full share and proactive with your bank, build a relationship with multiple banks. I encourage my clients to talk to other bankers, because you learn a lot, and it provides you options. And there's a lot of good people out there to help you. But I think the key there is just have the right partners and build a good relationship with a banker to at least understand, early on the steps you should be making, the things you should be considering and looking at to put together a deal.
Yeah. Yeah. Well, great. Well, Billy, I appreciate the time today. For those of you that are listening, make sure you reach out and connect with Billy on LinkedIn. I'll show his information and have a link to there as well for anybody that's interested or has questions about financing or acquiring a business or making a large purchase. Billy can help you out with that. So, like I said, Billy, thanks again for joining today, and I appreciate the time and the help that you've given me in the past.
Thanks for having me on, John. Appreciate you, man.
All right. Have a good one.
Thank you. You too.